So this is the big news of the day, and that's a big story on India Tonight. After much anticipation, a lot of speculation, JP.morgan all set to include Indian government sovereign bonds in the emerging markets bond index. According to the note that has been put out, it's going to come into effect from June next year. That's June 2024. The inclusion process is going to span across 10 months. It's projected to be complete around March 2025, so it is going to be a staggered kind of increase. And this would include a percent weightage every month, so that staggered increase would come into play. But what does the JP.morgan bond inclusion mean for India? This is what we got from ET Now's managing editor, Nikunj Dalmia.
The JP.morgan bond index has included Indian bonds. Now, what would be the implications and ramifications of this? First, let's understand. Very simple. That means more flow will come into the Indian bond market via global investors. If that happens, more flow means that bond yields, theoretically, they should come down. If bond yields, they theoretically come down and flows are more, that surely means the cost of borrowing in the system goes down. If the cost of the borrowing in the system goes down, it automatically will have impact on the government finances, and especially in this case, the fiscal deficit. Also, if fresh flows come into India, it will also have an impact in terms of where the rupee would move. Now, when it comes to rupee, we can argue that whether the Reserve Bank of India will intervene or not, but they will certainly like to curb the volatility. But one thing is evident, that this is a big door which was shut, and that gate has opened. And when that gate has opened, flows, they come into the bond market. And the bond markets, they continue to attract this kind of inflow. The differential yield between the developed market and in the Indian market will reduce. And structurally, this will continue to bring the cost of borrowing for government of India down. So it will have short-term, medium-term, and long-term implications. Now, what we understand is that this is just one of the index, which is the big index. There are two more indices which also could, two more indices which perhaps could also be coming out with same kind of a impact. If that happens, then we are looking at flows north of $300 to $400 billion starting June 2024, which would be staggered. Markets may want to price that in the run-up to the inclusion, but the bottom line here is that this is something which is path-breaking, permanent, and full marks to the government in terms of the way they have really managed to convince global financial firms in this case to accept and to accept the facts and to really make and give them a very important entry point, because it involved a lot of back and forth kind of a movement. The 10-year yields have already fallen by 7 bips, and the reaction is not going to be immediate. It's going to be spread across, because the inclusion will start from June 2024. But in terms of a move, in terms of an impact, in terms of a change, I think this is something which is going to have very far-reaching and very crucial and positive ramifications.
So that's what we got when, of course, this discussion was taking place, and we've had several of those discussions taking place through the day as soon as the news came out. Now joining us is author and senior journalist Tamal Bandyopadhyay to talk to us here on India Tonight, to break down the significance of the inclusion of the Indian sovereign bonds in the JP.morgan Emerging Markets Debt Index, its impact on the bond markets and the Indian rupee. Tamal, it's great to have you with us on the show this evening. Now we're seeing the bond markets come alive in a sense a lot more for us Indians. There has been the exclusion of Russia. There have been troubles when it comes to China. The options for global debt investors, they had actually come down. But now, how do you see India's inclusion help debt investors?
Well, it has been a long wait. I mean, you can call it wait for a decade. Raghuram Rajan 2013 spoke about it. But particularly the last 2 years, I think October 2021, that's where India was put on the watch list by JP.morgan, and 60% of the investors were supporting it. And now, of course, then in between, what happened is Russia got out. Russia had about 8% weightage in that that particular thing, and now India is in. Now, what does it mean? One, we are talking about how much money can come into this. It's very simple. If you see that if it gets into the entire JP Morgan suite of different indices, which JP Morgan has said, which is at this point of time 236 billion. And India's weight will be around 10%, so which means 23.66 billion. That's what the money we can expect over the next 10 months, that is between June 2024 and March 2025. That's one part of it. But indirectly, what can happen, it can happen more because there is the Bloomberg Global Index, which can, JP Morgan inclusion can actually open the door for that. And also another, that LSE subsidiary, that FTSE Russell, which has also been discussing whether to get India into it. That too also happens, the three combination, JP Morgan plus Bloomberg Global plus FTSE Russell, then we can see much more. But what is much more? If you see, Reserve Bank of India has been doing quite a few things to ensure the bond overseas investors' fuller participation. One of the things it did, of course, first is 2021, right. It did the margin requirement. It can borrow from banks. But before that, even 2020, it opened a fully accessible route. So certain bonds where there is no restriction, if you are a foreign investor, you can have the entire thing. Now, as we speak, there are 23 such bonds, yes. And the total outstanding of this is 330 billion. So theoretically, much right. more than 25 or 30 billion can come in if Bloomberg also come and then FTSE Russell also come. Of course, not 330 billion entirely, because
so
what JP Morgan has said that
Tamal,
it has to be outstanding 1 billion and 2.5
yes.
actually. Yep.
So all this fund flow that we are expecting, if there are going to be other indices that are going to include Indian sovereign bonds going ahead as well, taking their cue from what JP Morgan has done. But with this kind of added fund inflows, how much of a real impact do you see on India's borrowing costs? In the kind of current account deficit that we have, how much could that narrow down with this kind of fund flow? And obviously, this takes away a certain amount of instability in the markets as well, because typically what we've observed is that, hot money starts flowing out often when there is a spike in US bond yields. Now, that could change as well, wouldn't it?
Yeah, absolutely. I think the positive part is this. Theoretically, I would say theoretically, yes, it will have an impact on the bond yield, which means the yield, the government borrowing cost will go down. But if you see, as we speak, yesterday the market opened on a positive note, it rallied, and then it surrendered a part of the gains. And today the entire rally has been surrendered. So it actually, the bond yield today rose. So the enthusiasm, we are theoretically very enthusiastic, but the market has given up the enthusiasm, or whatever you call it, euphoria, because actually things it will start in June next year. So I think we need to wait. For the timing, the macro issues will have an impact on the bond yield. Definitely it is positive, but the people are talking about 10 years settling at 7%, etc. I'm not very sure what's going to happen there. I think we need to be, let's not be over optimistic, but if at all, there will be only positive impact. There could be positive impact on the rupee also, what Nikunj was talking about, and of course whether RBI will allow the rupee to appreciate, or it will that's a separate story altogether. But it will have both impact on the government borrowing program, the cost of borrowing and the rupee. But yes, there are challenges, as you said. One part is this: if you see JP Morgan release, it talks about it will start.
No, but just that point, Tamal, about the Indian rupee.
Yeah.
Tamal, that point that you were making about the Indian rupee, typically when you have rupee-denominated bonds, you can safely assume that when demand for such bonds goes up eventually, and that would be the hope, the rupee would appreciate. Is that a net positive or a negative, you think, for the economy?
No, that's as I said, that depends on the Reserve Bank of India, whether it will allow, to what extent. Because RBI, if you see that when the rupee depreciates, it comes in and sells dollar, and then that has an impact on the liquidity. And when the rupee is appreciating too fast, it also buys dollar. So when exactly the Reserve Bank of India wants the rupee to be there, keeping in mind the trade part. It depends on that. So, and that will have an impact on the liquidity. So that's one part of it. And other part which you yourself spoke about, that there are challenges. One is this, as I was talking about the liquidity part. JPMorgan will start a liquidity study soon to where to invest, which thing. Now here the Reserve Bank of India needs to figure out what it will do, because we do not have too many liquid bonds. Once you buy it, you need to also have an exit route. So that is not there. There are very few bonds. Now, many bonds are on the flexible, accessible route or FAR for investors, but every bond is not liquid. So liquidity is an issue which RBI needs to create. And second part is this: there could be external developments which can have an impact, which can have a certain exit. Suppose India has been given 10% weight, but now for some certain reason, in that weight comes down to 7% or 8%, then there will be an impact, or certain other external events which can have an impact. And at the end of the day, the currency risk is the bondholders, So it's pretty integrated, rupee versus this. I mean, the entire the JPM, wherever
in terms
whoever
of
is buying, they are taking the currency risk.
Yes.
They're taking the currency. And
when you say whoever is buying, and that is of specific interest, Tamal, the point about who actually is going to be able to buy, and that's a crucial point, because the domestic debt market, if you look at the interest in Indian sovereign bonds, across what we see in other parts of the world, that hasn't been the strongest. Do you think this inclusion, and perhaps more inclusion in the future, will change domestic participation in such sovereign funds?
That's I mean, absolutely, and it will also have an impact on the corporate bond market, because there is a connection. I mean, the corporate bond market always benchmarked. There is a linkage between the government bond market. So if the government bond yield goes down, the corporate bond market also will get the benefit. And there will be also passive investors. Once you get into this global indices, like you are not very particular, probably the one particular stock, but when you are betting on Nifty, buying Nifty, you are buying that stock. So similarly, there will be passive investment also beyond the direct investment. So overall, it's a positive, it's a great news. And I think we have been waiting for too long. I mean, it's like that Samuel Beckett's waiting for Godot that was happening. But finally, here the Godot appeared, and it's a good story. It's certainly a good story. I mean, but not a very smooth, like tomorrow we will see the entire thing. There's a dramatic change, rupee getting appreciated, bond yield going down, everything is fine. That's not going to happen. It will take time, because it starts from June. That's a technical part, and then there are the challenges what we need to, particularly the creation of liquidity. We need to do that. So the impact on rupee and the impact on bond deal at this point of time is theoretical discussion.
Yes. So a lot of that management will have to come in from the central bank as well, Tamal. And like you said, it's not like a switch that is going to get turned on and all of those positive kind of actions are going to unfold before us. It is going to take its time. We'll see exactly how it pans out. It's going to be a staggered increase as well. But for the moment, that's where we're leaving it. Tamal Bandyopadhyay, thank you very much for joining us on this important discussion here on this edition of India Tonight.